So my view is the opposite of everybody else's view currently. My view is that growth slows dramatically based on both the central bank balance sheet tapering and the higher prices of input costs like electricity, those kind of things, and also gasoline for cars. Those kind of things are fixed costs. And if you rise the fixed costs in people without raising wages as much, you end up with less demand. Or its potential is more borrowing. That's the only way. You either consume less or borrow more. It doesn't look like the banking system really wants to lend in that way, and household balance sheets are already, have an excessive amount of debt. So I think the balance of probabilities is a slower year, which is not what people expect. A slower year would tend to see a reduction in the rate of inflation, a reduction in bond yields, and a probable return of expansion of the central bank balance sheets, which is somewhat typical after almost every single recession. The central banks tend to wait for the economy to truly stabilize. And that process usually takes about 2 years of further rate cuts as the stimulus rolls off. And then the economy comes down to a trend rate of growth, which is too low. They stimulate again, it drifts down, they stimulate again, and eventually you find the equilibrium level of the trend rate of growth, which I think is much lower than people expect.
Why do you think you're a contrarian from this perspective?
Because most people see what's in front of their eyes and not what lies into the future. So you need to look at the kind of probabilistic trees of, okay, what could happen? There are no certainties. None of us know, but where did the probabilities align themselves? Most people look with inflation up now, therefore inflation, therefore wages will go up. And and therefore the Fed needs to tighten. That's the general how the market tends to think. The macro game is all about living in the future and looking backwards at the probabilities to say, what is the most likely outcome from here? And is there opportunity to invest accordingly?
So you think that the inflation rate of like almost 7% that we've seen in the US will go down?
Correct. Either mathematically, it's likely to go down. If you also just step back and say, well, what has happened to the price of oil? It's been coming off again. Copper hasn't gone up for some time. Lumber prices, well, they've come down. So what we're left with is natural gas in Europe is still very strong.
Yep.
Um, some of the agricultural complex is still strong because of supply issues. Those are the real issues here. I think we're already starting to see mitigation within housing prices and stuff like that, where prices again destroyed demand.